Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made.
Welcome back to the Equity Channel. Today, we're going to do a deep dive into the January barometer. It's a fascinating stock market indicator that suggests how the S&P 500 performs in January can predict the direction of the market for the entire year.
Yeah, and the January barometer, it boasts roughly a 75% historical accuracy rate since its inception in 1972. So this indicator's track record is definitely noteworthy, for investors like you.
The basic premise is simple. Up January, up market, down January, down market.
That's correct, yeah. The idea is that January sets the tone for the rest of the year. And Seasonal Stock Market Trends, which is a book dedicated to this topic, it introduces a pretty fascinating grading system for January to better understand its predictive power.
A grading system. Tell me more.
All right, so the system works like this. 1 point is awarded if the first week of January is positive, 1 point if the last week of January is positive, and 1 point if the entire month of January is positive. The most impressive statistic is that when all 3 points are earned, the market has historically closed higher 92% of the time, with an average annual return of 14.7%.
Those are certainly compelling figures. But what happens when the January barometer signals a bearish market?
Well, bearish signals, they haven't been as historically reliable, but the book offers a framework for interpreting these signals.
Okay, walk us through it.
Okay, so they use the following system. 0 points, meaning all 3 periods are negative, represent a strong sell signal. 1 point is a hold signal, suggesting to just hold cash, and 2 points generate a buy signal, but without leverage, meaning you shouldn't borrow to invest.
So even in a potentially bearish January, there are nuances to consider. It's not a simple sell signal.
Exactly. And we also need to remember the predictive power of the first 5 days of January. While not as strong as the full month, it offers an early glimpse into the year's potential market trends. Interestingly, bullish signals from the first 5 days have actually proven more reliable than bearish ones.
Okay, so what does that mean for us in 2025?
Well, currently, 2025 is on track for a bearish January barometer signal. The first 5 days have already closed in the red, which is a point for the bears. However, a bearish first week historically only leads to a yearly loss 40% of the time.
So it's not a guarantee of a down year. You previously mentioned that good news can sometimes be bad news for the stock market.
Yeah.
Can you elaborate on what you meant by that?
Yeah. So recently we've seen a surge in the 10-year Treasury yield driven by positive economic news. While this may sound positive on the surface, it can pressure key economic sectors like domestic investment, consumer spending, and housing.
Explain how that works.
Okay, so essentially good news can lead to rising interest rates. When interest rates climb, borrowing becomes more expensive, which directly impacts these sectors. For example, higher interest rates mean higher mortgage rates, making it more costly for people to buy homes, and that can slow down the housing market.
So good news leading to higher interest rates creates a ripple effect across the economy. What key factors should we watch to understand how this January barometer will ultimately play out?
Well, you should keep an eye on upcoming inflation data and how Donald Trump's agenda unfolds. Fourth quarter 2024 earnings reports will also offer valuable insights into corporate performance. And then, of course, we always need to be mindful of any unexpected developments in the labor market or global economic spillovers.
It seems there's much to observe as the month progresses. Let's delve deeper into these factors and their potential impact on the market.
Okay, so let's unpack this concept of good news potentially being bad news in the current economic environment.
Yeah, this seems counterintuitive.
Yep.
Explain why this dynamic is at play and its implications for investors.
Sure. So it all boils down to inflation and the Federal Reserve's response to it. Inflation erodes purchasing power, and central banks like the Fed typically try to combat it by raising interest rates.
Right, and higher borrowing costs are intended to cool down economic activity and curb inflation.
Precisely. But here's the catch. When the economy is showing signs of strength, like we've been seeing, strong job reports, robust consumer spending, it can actually fuel inflationary pressures. And this can lead the Fed to raise rates more aggressively, which can spook the markets.
So positive economic data could trigger fears of more aggressive rate hikes. It's like a delicate balancing act.
Yeah, it is. And this dynamic is particularly relevant right now because the Fed has signaled a strong commitment to taming inflation, even if it means slowing down the economy.
So this creates uncertainty for investors, right? Because they're trying to determine if positive news is truly positive or a sign of even more aggressive rate hikes to come.
Yeah, exactly. And navigating this uncertainty requires staying informed and understanding, the forces that are driving market movements. Go beyond just reacting to headlines and really try to analyze the bigger picture.
And that's precisely what we aim to do here on the Equity Channel, right? We equip you with the knowledge and insights to navigate these complex market dynamics.
That's right. Knowledge is power, especially when it comes to investing. Let's shift gears now and discuss another factor that could influence the January barometer, and that's Donald Trump's agenda. While this is a politically charged topic, understanding how political developments can impact markets is crucial.
Absolutely. And just to be clear, we're not endorsing any political viewpoint here. Our focus is on analyzing how political events and policies might affect the economic landscape and consequently the stock market.
Correct. And when it comes to Trump, there are a few key things worth considering. First, his policies tend to be market-moving. For example, his trade policies and tax cuts, those impacted various sectors.
Right, and those impacts have not always been predictable or universally positive.
True. Some sectors have benefited while others haven't. And any indication of a shift in his agenda or new policies could create ripples in the market.
We also need to consider the potential for political instability or uncertainty, right?
Absolutely. Political turmoil tends to breed market volatility. Investors generally crave stability and predictability, so any event that threatens that can trigger sell-offs.
So, essentially, we need to assess the potential for Trump's actions or even his rhetoric to introduce uncertainty into the market.
Yeah, it's not just about his policies, it's also about the overall political climate, and the level of division or gridlock. Even if his policies don't directly impact the market, a highly polarized or dysfunctional political environment can still erode investor confidence.
And that can result in market volatility and downward pressure on stock prices. Investing is really about understanding the broader context, including the political landscape.
Well said. Markets are complex systems influenced by many factors, and political developments are certainly one piece of the puzzle. Now, let's examine another critical element for you to consider: corporate earnings.
So we've covered historical trends, economic data, and political influences. Now let's focus on corporate earnings, a critical factor in understanding the market's direction.
Yeah, fourth quarter 2024 earnings reports are on the horizon, and they offer valuable insights into how companies are performing amidst the current economic and political landscape.
Okay, and earnings reports provide crucial information about a company's financial health, profitability, and future outlook. What should investors be watching for in these reports?
Focus on revenue growth, profit margins, and guidance for the coming quarters. Revenue growth indicates a company's ability to, expand and attract customers, while profit margins reveal how efficiently a company manages costs and converts sales into profits.
Right, and guidance offers insights into a company's projections for future performance.
Exactly. Guidance helps investors understand, what to expect moving forward. And by analyzing these metrics across different companies and sectors, investors can gain a broader perspective on the economy's overall health. And it can help to identify potential opportunities or risks.
It's like assembling a puzzle, with each earnings report providing a piece of information to help us understand the bigger picture.
Right. And remember, earnings reports can surprise the market. Even a company with solid performance can experience a stock price decline if its earnings report disappoints. Conversely, a strong earnings report can boost a stock even in a challenging market.
This underscores the importance of staying vigilant and conducting thorough research before making any investment decisions.
Exactly. Don't blindly follow the herd or react solely to headlines. Dig deeper, analyze the data, and make informed choices based on your risk tolerance and investment goals.
Now let's address those unexpected developments, the wild cards that can impact even the most well-thought-out investment strategies.
Right. Black swan events, geopolitical shocks, unforeseen shifts in consumer behavior, these can all disrupt the market. So building a diversified portfolio is crucial to withstand these unexpected shocks.
So diversification is key to managing risk.
It is. Don't concentrate your investments in just one area. Spread them across different asset classes, sectors, and geographic regions. This strategy helps mitigate losses if one area of your portfolio underperforms.
So a diversified portfolio is designed to kind of weather the inevitable market storms.
Precisely. As we conclude this deep dive into the January barometer and its influence on the market, remember that knowledge is your most valuable asset.
Stay informed, stay curious, and stay ahead of the curve. Make sure you subscribe to the Equity channel and turn on notifications so you don't miss any upcoming insights. Every time we drop a new episode, money is made.